Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Shahrawat, Director of Strategic Insights and Advisory at Rosenblatt Securities. Dee, it's great to see you again. Welcome back to Trade Talks.
Thank you, Jill. Great to see you.
All right, we have a lot to unpack here with FinTech because they have been evolving. They've been growing, not just from distributing financial products to now becoming regulated banks. It's a real thing now. What's attributed to that growth?
Yeah, sure. So the first phase of FinTech growth that began 2010 to say about 2018 saw predominantly, consumer-oriented companies and mostly FinTechs distributing financial products. And really, the opportunity was in distribution at that point of time because the big institutions were not doing a great job. The user experience wasn't great for the consumer end for distributing financial product. So smart entrepreneurs basically combined with venture capital money focused on the consumer end of distributing financial products. Last 2 or 3 years, we've seen a lot of companies actually in the FinTech space now going up the value chain into focusing on manufacturing of financial products. And that's resulted in FinTech companies getting regulatory licenses. So we saw a lot of challenger banks this year, Chime, Revolut getting licenses. You had Square getting a banking license in the payment space. And the insurance space, you've got some of the large insurtechs like Lemonade and Root that went public last week. They're now insurance carriers. So increasingly, we're seeing these fintech, insurtech companies not just distributing financial products, but becoming regulated banking entities as well.
How did COVID-19 impact the fintech space? Did it accelerate many of these trends in place? Were there any losers as a result of it?
Yeah, absolutely. Let me answer the question in 2 parts. One is, the whole consumer impact in terms of everything sort of getting 30% lower in terms of transaction volume, business activity, all of that has impacted negatively fintechs, as they have traditional institutions as well. But the flip side is because a lot of the fintechs predominantly are software-driven digital models. To the extent that activity has actually gone up in the digital space, the fintechs have actually, benefited from that. So that's kind of observation number one. But within the fintech space, we look at 6 different segments of the fintech marketplace, and it's widely different. Digital lending, for example, has done really badly, both in the private and the public market. Public market companies like OnDeck have done pretty badly. Private digital lenders have done pretty badly as well. In the robo-advice space, you've got, high flyers like Motif that went out of business in April, sold off the business. So that's been sort of negative impact on certain parts of the fintech marketplace. But payments, for example, has continued to do extremely well. Square in the public market gone up in valuation this year. It's trading at about 280 times trailing forward PE. The Square stock has gone up 400% this year. I wish I bought it back in the spring. So in the payment space, things have done pretty well. Capital markets, always a feast or famine business. Massive volatility, transaction volume has been pushing up all players in the capital market space. But on the losing end, it's basically been digital lending, robo-advice, mixed picture. Insurtechs have done pretty well. A lot of the insurtechs have gone public this year. I talked about Root and Lemonade that is doing pretty well in the market. SelectQuote and Duck Creek as well. So can you imagine a sleepy sector like insurance actually has created some of the most high-flying public companies this year in the fintech insurtech space?
Let's go back to Square for a moment because there have been encouraging mass adoption crypto announcements made recently. Of course, Square is one of them. PayPal was a huge announcement. If you're a large traditional institution, it's a bit late to start working on your fintech DeFi crypto strategy.
Not at all, Jill. We think this is more of a, the whole crypto plus blockchain space is a 10-year growth cycle, right? And this is an area where I have never been as conflicted in my mind between being extremely optimistic at one stage and very pessimistic at others. So it's happening, bits and spurts. We happen to be going through, last 2 or 3 months of confluences events where, Bitcoin is back at 14,000 the first time since about January of 2018. There's been more institutional adoption. Square, obviously, both offering crypto on the Square platform, but Square also buying $50 million of it. So there've been a lot of positive indications in the crypto space and the blockchain space. We absolutely don't think that we are probably at the end of the first innings, but definitely not any further along. So it's not too late for big institutions to jump in with both feet.
All right, Dee, you are 14 of number 15 guests today, and we've spoken about the election impact on stocks, on treasuries, on the rest of the fixed income complex, the commodities complex. If Biden were to win, what changes can we expect to see in fintech land? What laws or policies could be overturned or implemented that could impact the space?
Sure, Jill. So, we're not regulatory experts, we're bankers. So I'll put my banking hat on and say the first one I think is the whole M&A landscape, right? So a Biden administration would be a higher amount of chance that there'd be more antitrust issues, and regulators and Department of Justice would more closely scrutinize M&A activity amongst large banks. That, in a way, would mean maybe a little dampening of the climate for M&A transactions, particularly amongst large financial institutions under a Biden administration. That net-net actually might mean good news for fintechs, because the large banks, not able to now easily buy other banks, would actually buy, hopefully, more fintech companies. So that's point number one. Then there are sort of number of smaller things. For example, in the robo-advice space, in the retail financial advice space, you might remember that, or listeners would remember that regulation best interest was passed under the Trump administration, which was a watered-down version of what was called the fiduciary standard, which was basically imposing much more onerous requirements on financial advisors under which they would operate and offer financial advice. Under the Biden administration, we might have regulation best interest basically further being scrutinized, and we might go back to the more extreme view of that, the fiduciary standard that was first tabled by the Obama administration about 8-9 years ago. So that's one. The Biden administration has talked about creating a public credit reporting agency, which might compete with the big credit bureaus. That would be a major change. We think that might actually kind of hurt net-net the fintech space, because a lot of the alternative credit requirements that the fintech guys have been talking about might actually be subsumed by this new public reporting credit agency. But anyway, reporting agency like that might take 2 or 3 months to get up and running. Last one I'll talk about for the time being would be the cryptocurrency space. Under the Trump administration, I would say it's been a mainly hands-off approach by regulators and politicians in the crypto space. We've had some clarity of laws and rules, but by and large, the crypto space has not had tremendous amount of guidance or scrutiny or regulatory guidance by the government. That might change under the Biden administration. So in a way, it might be good for institutions, because it might increase institutional confidence that the regulators are standing up and watching for everybody's interests. But it might sort of slow down the pace of change in the cryptocurrency space. So those are the couple of areas we're looking at where there might be change if there's a change in administration.
Indeed, to wrap up here, you said we're still in the early innings of what's capable with fintech. What are you looking at a little bit longer term? What's next?
Yeah, sure, Jill. So I think overall, like your first question was, we are moving past the initial stage where most fintechs are focused on just purely distributing financial product. So now we're looking at doing the harder job, right? Manufacturing products, servicing financial services products. So we're seeing fintechs moving up the value chain. That's point number one. Second point is that the first phase of fintech growth was very consumer-oriented fintechs. We're seeing more institutional plays. That obviously means slightly slower growth, but we think that B2B space is going to be where a lot of the growth might be. And third point I would say is, while the innovation gap between the fintechs and the traditional companies, let's say was 10 percentage points about 10 years ago, that's now narrowed to about 5 or 6 percentage points. So it's tougher for fintechs now as the big institutional incumbents have caught up significantly. Case in point is Zelle, the big consortium-led payment system. They just recorded 1 billion transactions of payment volume over the last 12 months. Major achievement for the big incumbent banks. So I think net-net, we're very positive about the fintech space, but obviously a much different environment than about 5 years ago.
All right, Dee, great to catch up with you as always. Thanks for joining us on Trade Talks.
Thanks a lot, Jill. Appreciate your time.
You got it. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.